All right, everyone, we will go ahead and begin. Welcome to today's Titan Talk. We are super pleased to have certified financial planner Jordan Fish as today's Titan Talk speaker. For those of you who may be tuning into this Titan Talk for the first time, these lunch hour presentations feature IWU alumni, friends, supporters, faculty, and staff who are leaders in their field. I am Kaylee Matheson, Director of Alumni Engagement at Illinois Wesleyan University, and I'm going to be your host and moderator for today's talk. Just a few housekeeping notes before we begin. You are viewing today's webinar as an audience member, and therefore you will not have the ability to turn on your microphone or your video at any time during the presentation. Questions are encouraged and can be submitted through the Q&A feature at any time. And if you have any technical issues, you can reach out to our Office of Alumni Engagement at 309-556-3145. A recording of today's webinar will be available to view on the Office of Alumni Engagement YouTube page. You will be getting that link sent directly to your emails tomorrow. All righty. Now I'm very excited to give you a brief introduction of Jordan. Jordan is a 2005 graduate of Olivet Nazarene University and joined Illinois Wesleyan in January of 2022. He has served in higher education and admissions, financial aid, and advancement offices for the past 16 years. He earned an MBA at ONU and went on to DePauw University to complete postgraduate coursework in finance and financial planning. And in 2014, Jordan successfully passed the 2-day, 10-hour examination for certified financial planner credentials. That is a lot of testing. He has completed 30 hours of coursework in advanced financial planning annually to maintain the CFP certification. And he is also an active member of the Chicago Council on Planned Giving. Jordan specializes in asset-based gifts, and he seeks to first serve individuals as they examine what matters most to them in their charitable giving. His passions include how to explore the why of wealth with families. Jordan is married to Rachel, who is a developmental therapist, and they are blessed with 2 children, Josiah, age 10, and 8-year-old Hannah. And in Jordan's free time, you will find him reading, camping, or hiking with the family. Thank you so much for joining us today, Jordan. Please take it away.
Thanks, Kaylee. And thank you for everyone showing up today. We're going to cover a few things that have transpired recently that will likely affect most of the individuals on this call and also your children. Before I start this, though, I always have to go through the disclosure statements. None of this is to be considered personal financial advice. Please consult your own tax, financial, and estate planning attorneys for anything that would be unique to you. Today is more going to be educational about a specific topic related to the Secure Act. So if you don't know, the Secure Act is titled the Setting Every Community Up for Retirement Enhancement, so Secure Act, and it was passed in December of 2019 and became law as of January 1st, 2020. The legislation created a lot of changes for long-term retirement savings, and it will have financial impacts on Americans of every age. You may have also heard just over the last few months, Secure Act 2.0 is now pending legislation that will build to expand upon the Secure Act. So that has passed the House as of the end of March of 2022, but the Senate is still working on hammering out that final version and what remains within those committees that will be on that bill. So there are a few things that will likely change even within the next few months regarding what we're going to talk about today. But that is part of policymaking, is it changes quite frequently, so we have to stay on top of it. So again, those are the disclosures. We're going to go through quite a few different things today, but hopefully it'll be informative and at least help you as you explore your plan. So the first thing we want to talk about today is we're just going to do an overview of the Secure Act. We're going to talk about one specific aspect, which is going to be the transfer of wealth through your retirement plans. That is a huge asset pool, and the government is looking at that in a specific way, and we'll get into some details there. We'll talk about the big change, which was required minimum distributions, or RMDs. They changed that age, and that has the potential to change here in the next few months with Secure Act 2.0. The big change is going to be the death of the stretch option on those transferred to heirs. And then because I come at things from a charitable planning perspective. We're going to talk about maybe a unique way that you could include charity and your children or heirs through planning that would hopefully limit a little bit of the tax burden and transfer what would otherwise be taxes into some things that you would care deeply about with charities that you know and love and support currently. So those are the things we're going to hope to talk about in the next half hour or so. Hopefully, like I said, it is educational and informative. So what are the things that the Secure Act did? It did some really good things, and then it had some other things that I think are going to be potentially problematic long-term for planners. But we'll talk about a few of the good things, and we'll talk about a few things that we need to maybe have strategies for. So it increased small employer access to retirement planning. More part-time employees are now qualifying for 401k plans. So the nice thing about that is that it is increasing the percentage of participation. Just even this last year, it came out. It's right around 67, a little under 68% of people are now being able to invest and plan for their retirement through their employers. So that's a good thing. It enhances the auto enrollment. So individuals are not necessarily having to fill out a lot of paperwork in order to start saving for their future. So that does help people to start that early process. And if you started saving early, you have probably seen that if you started in your 20s and you're now entering into your 50s and 60s, you've seen how much just even a small amount of investment can grow, even if you're doing it in small amounts over a long period of time. So that auto enrollment is a key feature. It does increase the required minimum distribution age. So that went up from 70.5 to 72. So it gives a little bit of time, a little bit more time for planning as far as that distribution age. So when you have to start taking money out. So the IRS understands that you took those funds, you put it in pre-tax, it's grown pre-tax. They're wanting that tax revenue to start coming in. So at 72, they say you have to start taking funds out of your assets there. And that is something that everyone has to kind of keep an eye on as their birthdays roll around there. So it does remove the age limit on IRA contributions. So people are working longer. So they're having the ability to now put more money into their contributions in their IRA if they are working. And again, that is the big key there. You do have to have that earned income in order to contribute to that IRA. It does increase annuity options inside retirement plans. As pensions have gone away, that three-legged stool of financial planning or retirement planning, one of those was pensions and that guaranteed income. So you'd have your pensions, then you'd have your Social Security, and then you'd have your savings or retirement plans that you have contributed to. Many individuals have found that those pensions are no longer available through their employers. So by increasing the annuity options inside your retirement plans, it transfers some of that risk from you putting it into the markets that do have volatility. So it goes up, it goes down. By contributing to those annuity plans, you get that fixed payment there. And the largest thing is the changes after death on your transfer to your heirs. So the way that your funds are transferred from those IRAs, from those 401ks, those 403bs, simples, SEPs, all of those funds that are pre-tax that you're putting in, those are things that are going to be changed as far as how that has worked. My finance professor at DePaul always said your IRA, to the IRS, your IRA is IRD, which means at death, you're going to pay taxes. So we view it as an asset. They view it as a revenue stream. So your IRA is something that we got to be looking at as far as the transfer of that asset. So we'll start at the end. So when we're looking at it, why did they make these changes to the planning for IRA assets? So it used to be where you would have the ability to stretch out your IRA if it transferred to your children. So that stretch provision at the last to pass, your child, let's say they inherited it when they were in their 50s or 60s, they would have, 25, 30 plus years that they would be able to take out small increments over time. It would go into their income taxes, but it would be smaller. And that would be how they would work to take those distributions from that inherited IRA. That's now going to be a little bit different here. So why did they make those changes? Well, one of the largest assets in individual estates is going to be that plan that most people have set up, those retirement assets. And the Secure Act may have a huge impact on how you have your estate planning done. So you're going to probably want to check with your advisors about how that Secure Act is going to affect not you, but your heirs within that process. So many people are going to receive information from charities and other sources, the AARP. They're going to be sending out information as it becomes more clear as to what actually is going to be going on. Actually, just in March, there was about 280 pages of proposed regulations that the IRS issued just on how required minimum distributions are going to work. It's complex and somewhat confusing. I don't necessarily feel that all of their proposed regulations made it easier to understand, but those proposed regulations are going to be things that we're going to need to be conscious of. And again, these are proposed regulations. These have not been finalized, but just for reference, in one of my hours for training for my CFP, one of the presenters made reference to the fact in 1986 is when they had a very large tax change as far as rulings were approved. That did not happen until 17 years later. So in about 2003 is when they finally hammered out, this is exactly what we meant in 1986. So there will be rules and there will be things that will change within those rules. We just have to be conscious of that. So just need to address those concerns and then try and find solutions as we know what the rules are once those change. So in the midst of all of this, we will keep Willie Sutton's wisdom in mind. Willie Sutton, if you don't know, he was a famous bank robber. He stole about $2 million throughout his time stealing from banks. And a reporter asked him, well, why did you steal from the banks? And he said, well, that's where the money was. So the IRS certainly knows that most of our assets, or a lot of our assets, or a good portion of our assets are going to be within these vehicles. So they're going to go after it for specific reasons in order to fund some of the bills and the spending that has come out of Washington recently. So my slides are not moving forward. So, oh, here it is. All right. So IRA assets, as far as the pool is concerned, assets in IRAs have grown at about 10% per year over the last 25 years. So it has been a pool that has outpaced inflation historically and has grown and been a great resource for most Americans. So now there's 49 million households that have traditional IRAs. That's about 40% of the population. Most of those IRAs are invested in a typical breakdown. So there's stocks in there, there's equity funds in there, target date, life cycles, bonds, money markets. All of those things are geared to be able to grow with inflation and hopefully provide a good stream of income for you as you age and go into retirement so you can replace that income from a W-2 or from your working life there. So just to kind of give an idea of how much it's grown, this chart I think is always informative as far as the total market assets within annuity, government defined benefit, and defined contribution plans, private also, and IRAs. So you can see that growth has been pretty strong there over the last 20 plus years. So going from 11.6 trillion to right around 39.4 trillion. So most Americans have done pretty well if they have been invested in making those pool or that asset go up. Now, one of the things that I do talk about for individuals, and we'll talk about in here, is how you can give charitably within that asset pool. So there's two unique ways that you can give out of your IRA. During your life and then at your passing. And we'll talk about both of those types of gifts here in the presentation. But I know most of our friends here on this call are generous in ways to their community and also to Wesleyan. And we want to make sure we cover how some of those features can be used within the plan here. So the Secure Act and charitable giving, good news is if you're charitable, there's still a number of different ways that you can support. Naming a charity as an IRA beneficiary, it's easy. You can fill it out with a designation form, a beneficiary designation form. There's no lawyer required, and it makes it very, very simple to make those changes if you would choose to. If you have questions regarding that, please contact our office. You can also talk with your planners and attorneys about that too. You could also do it during your lifetime as far as giving is concerned. So if you're over 72 and you must take a required minimum distribution from your retirement plan and you don't need those assets to live on, you can make what's called a qualified charitable distribution. So the funds that you have put into your IRA, you put in pre-tax, it has grown with no taxes. And if you choose to do a qualified charitable distribution, that comes directly to your chosen charities with no taxes. So this is funds that have never been taxed before that would go to support the chosen charities that you love and support. So this is still able to do at 70 and a half. So they did realize, okay, we've been allowing people to do qualified charitable distributions at 70 and a half. We know we're raising that required minimum distribution age to 72. We don't want to take away this charitable avenue because many people are using that in order to support their support many different charities that the government understands fills in the gaps that they may not be supporting or providing enough funds to. So this is only for your IRAs. It does not qualify for 401ks, 403bs, SEPs, simples, 457s. Those are not applicable for qualified charitable distributions. It must only be out of an IRA. So not to say you couldn't give from your 403b or 401k, it's just you'd have to realize the income and then make a contribution to your charity. And you get a deduction, but it's an offset there. Whereas if you do it through a qualified charitable distribution, it's considered above the line on your taxes. So it has never gone through your AGI on that side. So it is a nice thing to do, and it is something that we have seen many Wesleyan supporters choose to do, and we're excited as that continues to grow. More and more people are considering and using that giving vehicle. So you can support charities like we talked about. You have to do that RMD at 72. If you do the RMD to yourself, it is 100% taxable. If you do it through a distribution of a qualified charitable distribution, you can direct up to $100,000 annually out of your RMD to a charity without having to realize any taxes. But they do, like we talked about here, they do say there is a maximum of $100,000 you can transfer to the charity out of your IRA. It saves taxes by reducing your taxable income. You don't have to be an itemized deduction in order to use this strategy. So it is a very increasingly popular strategy. In order to do that, please talk to your accountant and your financial advisors about this if you're 70 and a half and older and you are charitable. So it is a good thing to use. Required minimum distributions, we talked about that age was raised from 70 and a half to 72 for the RMDs. It could provide some tax benefits, but it also could provide some hurdles. And we'll get into the hurdles there here in a second. That overhaul of the RMD rule is going to be, it's going to have some effects on your planning and what will happen with your loved ones there. I will say of note, one of the major changes that is being proposed within Secure Act 2.0 is to even increase that beyond 72. So Secure Act 2.0 would say as soon as that legislation is signed and approved, it would move the RMD age from 72 to 73. And then in 2030, it would move it from 73 to 74. And then in 2033, it would move it to 75. So that RMD's required minimum distribution age has the potential to move to 75 here if the proposed legislation does get passed. So again, we'll see what that looks like. Much of what we're talking about today may change even by December, so going into 2020. So that covers a little bit about the required minimum distributions. So there are three big changes to that RMD side. IRA contributions are allowed. We talked about that. So many people are continuing to work well into their 70s nowadays with increased health and the long-term age graphs going up, and they did change even the tables as far as that was concerned. So as aging continues to be part of our trajectory as far as the numbers are considered, more and more people are working longer. So it used to be you couldn't contribute to those IRAs past that certain age. Now they're saying as long as you're working, you can go ahead and contribute to your IRA. So those IRA contributions continue to go. Number two, IRA distribution. The age has changed, gives the owners of the IRAs a little bit more time to figure out how their accounts are growing and if they need it and how they're using it. Now, within that, that generally means over time, the longer you don't touch an investment asset, it continues to grow. So kind of that snowball effect as it rolls down the mountain, it gains more snow. Generally speaking, your assets are going to continue to compound. So as long as that compounding snowball keeps rolling, those assets continue to grow, which means the longer you delay, you're probably going to be pulling out from a larger asset base. Granted, this year is probably not the year we're going to talk about a lot of growth because of the volatility in the market. But historically, it's generally about 7 out of 10 years are going to be up in the market. A little over 7 out of 10 years in the market is going to be up, and then 2 or 3 out of every 10 years is going to be down. So over a long enough period, you should see growth within those funds. So if we're moving it from, let's say, 7.5 to the projected 75, that's 4.5 more years of potential growth before you click the button that says, hey, okay, I want to start pulling money, or I have to start pulling based on what the IRS says. So those IRA distributions are going to be things we'll want to keep an eye on, and we want to make sure that we get that activated. Most of our providers will activate that. They'll let you know right away, hey, you're reaching this birth date, because they'll have all of your data information. You need to start doing this or start the process of activating the requirement of distribution. They don't want to see you get penalties. They don't want to see any of those issues there. So starting in 2022 again, individual reaches 72, they must start taking IRA RMDs by April 1st of the following year of that birthday. There are many calculators online, whether you go to Fidelity, or Schwab, or any of those other institutions. They'll show you exactly when you need to start doing that process to make sure that those RMDs are taken care of. One specific thing that I did want to bring up, if you do qualified charitable distributions, you can do that at age 70.5. But we talked about some people are working much longer, so they're going to be contributing to their IRA much longer. So what they said is, okay, you can't give a distribution out of your IRA and then contribute to your IRA. So it offsets. So there are some things that we want to keep an eye on as far as that running tab of if we're contributing, but we're also doing a charitable distribution. You want to keep an eye on those things and the specific rules there. Your accountants, your attorneys, and also your charitable organizations will help you through that process if that's something you have questions about. Stretch IRAs. So this is what most significantly changed for individuals within the changes for the Secure Act. So before that, many beneficiaries, they took small requirement of distributions each year over their life expectancy. So like we talked about, if you inherited when you were in your 50s, you could live until your mid-80s. So it'd stretch it out over 30 plus years, getting smaller increments. That strategy for inheriting those tax advantage accounts is now kind of gone away for most people. So this allowed that IRA to grow, and it provided a full lifetime of benefits for your heirs. This is now going to be going away. So that depth of the stretch, for most beneficiaries, the Secure Act requires the entire account in the IRA or defined contribution plan to be distributed within 10 years after the owner dies. So that is going to be a strategy that millions of people had been planning for and set up plans for, whether that was through a conduit trust or through coaching their children, hey, this is how you should do it with the advisors that they have. That now has gone away for many, many people. So there are now a couple different classes of beneficiaries. So there's an eligible designated beneficiary, so that has to be a human. The eligible designated beneficiaries are going to generally be your spouse. It would be minor children. It would be individuals with disabilities, individuals not less than 10 years younger than you. So you could give it to your sibling. In some cases, that would work. You can give it to your sibling, and your sibling could stretch it out. You can give it to your spouse, and they can stretch it out. But anything beyond those few categories there that we sorry. Anything beyond those few categories there would be ones that would have to take it out in the 10 years. So those would be considered non-eligible designated beneficiaries. Generally, that's going to be a human, sometimes a trust, but you would have to liquidate the full asset within 10 years. And then there are non-designated beneficiaries or non-humans that would be charities, estates, anything that would be there. I know that there's always, especially in my line of work, you read about unique things where individuals will leave their IRA to their dog or their birds or such like that. So anything that would be like that would be considered a non-designated beneficiary. Charities, again, pay no taxes on those transfers based on their 501c3 status. If you leave your estate as the primary recipient, it's generally not recommended because there's a compressed tax rate, and then it also goes into the estate tax calculations there. Most people don't consider much about that because the lifetime exemption it increased this last year from 11.7 million to 12 and a little bit million. So each individual, if it's a couple, it's 12 million and a little bit for each of them. So it's 24 million roughly that they'd have of a lifetime exemption. And again, that's great for most individuals, but they don't think about the tax implications of the income and respective decedent through these contributions that they've made that have not been taxed. The government views that in a different lens than what they would look at for your lifetime exemption. So your children are going to receive that, or your heirs would receive that, and they would have to pay those income taxes there. So again, now it has three beneficiary classes. There's a podcast series that I listened to about planning, and they have now done about 6 hours just on these three designated classes with case studies. It is very complex and a little bit interesting to try and go through and understand exactly the specifics of it. So as you're making plans, please consult with your attorneys and accountants and planners on it, because each one of these specific classes of beneficiaries has specific rules of how they would be viewed there. So under the Death of the Stretch, the Secure Act, no RMDs for inherited stretch IRAs. Beneficiaries only ensure all the money needs to be taken out within 10 years. Now, there are some rules where it says, okay, you just have to liquidate it within 10 years. But depending on some classes of beneficiaries, you would need to take out at least in equal payments 1 through 10. So year 1, 2, 3, 4, 5, 6, 7, 8, 9, all the way through to 10. Again, that's where it gets a little bit more complex, and you just want to make sure that you're following the rules as they're outlined within the Secure Act provisions. So, you kind of have to act rational within this. So why was this passed? So the government wanted IRA and 401ks to serve as retirement accounts, not as tax shelters for your heirs. Now, what we did as planners is we took the rules that we had previously, and we found that it did serve as a really great tax shelter for planning there. But the elimination becomes a moneymaker for the IRS and for the government. So over the next 10 years, this is a low estimation. There are some higher estimations there, but it's expected to raise tax revenue of about $18.4 billion in new money by eliminating the stretch provision for heirs there. So that anticipated revenue is largely going to pay for a lot of the Secure Act benefits that they're rolling out, and some of the funds that they've already spent in the last few decades there. So I expect it to generate a lot more even over the next following 10 years. If you remember back to that chart from 2000 to 2021, how it went from like 11 trillion to almost 40 trillion. as those assets continue to compound, those numbers are going to kind of continue to balloon and inflate. And we'll run through a scenario here that kind of shows you how that distribution comes out. So again, this comes back to one of the things that I said at the beginning of this plan. One of my DePaul professors said, to the IRS, your IRA is IRD. So to the IRS, your individual retirement arrangement is income in respect to the decedent. So you see an asset, the IRS sees income. So we want to make sure that as we're looking at this, we're understanding what the implications are. So we talked about some of the exceptions to the RMD, surviving spouses, children under the age of majority. So generally that's going to be 21. If you're disabled, chronically ill, individuals not more than 10 years younger than the deceased account holder. So those are ones that the old rules still apply. So we created new rules, but there's a carve out for people that are not in the new rules that can do the old rules. So understand that for most individuals or couples together, it's not going to change a whole lot to you and your spouse. So if you're sitting together on this call and you're next to each other, you look at each other, it's not going to change much. When it transfers from one spouse to the next spouse, they still can do that, that eligible designated beneficiary where they have the ability to take it out over their lifetime. Your spouse will not have to liquidate that over 10 years. So that's a good thing. But once we get past that into that next generation for your children, your grandchildren, that's where that tax implications will be more important there. So the IRS rates for the RMD tables, those are updated. The factors can be found on IRS publication 590B, and I did have that here. So you can see the age and what the divisor is based on the account number. So you can look those up. That is easy enough to find, and those numbers are updated occasionally. So keep an eye on what those are, but as you can see, as you age, and many of our population are continuing to have many more birthdays, which is a good thing, they are needing to take out more and more. And I talk about with individuals all the time, especially on the planning side, you go from go-go years to no-go years within your retirement. So once you get to a certain age and stage in life, you want to stay home. You want to be close to your doctors, close to your families. It's difficult to do long travels. It's difficult to say, okay, I want to jump on an airplane and fly somewhere. So generally speaking, when you get into those ages of 90s, you don't need a lot more of income, but they're going to require you to take out more. As you can see, those divisors continue to go down from your 70s all the way down into your 90s and into the hundreds there. So that 10-year rule, again, we talked about it, going to be problematic for some beneficiaries, especially if in their 40s and 50s, because generally speaking, when you're in your 40s and 50s, you're at the peak of your earning years. So it limits that time frame. So it's going to have to be taken out, and it's going to be taken out in their highest earning years, and it comes in as income, which means it goes into their tax base for their ordinary tax base of income there. So we'll go through that here in a second about how that rolls out there. This is a good calculator, the RMD calculator, and I use some of this in order to do some of the scenarios here. But securermd.com, if you go there, there's a little calculator that you can kind of put in a little bit of the numbers and kind of see how that would look like pre-secure rules and now post-secure act rules. So we're going to do this as a scenario. So I ran this number. We rounded numbers just for clarity there. But let's say you have a $1 million IRA. Your beneficiary is going to be 50 when they receive it, and you receive about a 6% return on that $1 million. So before the Secure Act, they would only need to take out about $30,000, and it would grow. So it would go from $1 million to $1,030,000, and they would take out $30,000. After the Secure Act in year one, instead of taking out $30,000, they're going to need to take out $106,000, and you'll see those remaining balance, the difference there. So the required minimum distribution difference for that heir is going to be $70,000 more in distribution, which means that that's going to go into their taxable income. So that was year one. So let's look at what year 5 and year 10 looks like. So year 5, they're in that, so they would now be 55 years old. Under the old rules, they would be taking out right around $37,000 there. And they would still have a remaining balance after year 5 of $1.1 million. It gives them a good cushion to kind of look out for their next few years. Whereas year 5 and the new rule, they would need to take out 126, a little over that, 126,000 and change, and that remaining balance would now be 669,000. So you can look at that difference as far as the core of the account. Now, instead of 1.1, it's 670,000 roughly there. So you're seeing that kind of accelerate up. The difference there is becoming a little bit more extreme there. So year 10 is when you have to have it concluded. So all of the assets need to be out of that IRA in year 10 if you are not eligible to stretch it. So those unique categories there. So year 10, pre-Secure Act, you would only need to take out about $49,000 and you'd still have $1.2 million. That $1.2 million, if you're the person who's passed and given it to your children, that has some effect on how your children may be able to do some things for your grandchildren, and then maybe for what would have been your great-grandchildren there. But now, under the new rules, they would need to take that last amount out, which would be roughly $168, almost $169,000, and their value would now be at 0. So the RMDs over that 10-year period, instead of taking out $385,000 that would have been taxed at ordinary income tax rate, now they're taking out $1.3 million over that 10-year period, all taxed at that ordinary income tax rate. So let's do that based on a unique scenario. So let's say that, again, age 50, and they are earning already $120,000 a year, and they inherit that $1 million IRA. Well, distribution at that first year is only going to bump them from 120 to 150. So they remain in the same tax bracket there under the old rules. Under the new year rules, they have to take out a little over $100,000. So that's going to then bump them, instead of in that tax bracket at 24, it now bumps them up to 35% tax bracket there. So it's going to have quite a change or effect, especially as you look at it and you say about that last year, they're needing to add in almost $170,000 in new in income from that IRA. So this is one reader's comments as far as how could the AARP have supported this. You know, you're going to see 35% of your inheritance to be paid out in taxes, and that this is an outrage. I was at a conference, and one of the speakers there said he was at an Ed Slott conference, and Ed Slott said that while talking to some of the lobbyists there, they knew that the individuals who have these IRAs that are large IRAs, they are voters. So they're not going to tax them during their lifetime. They're going to tax it during the transfer after they've passed and they're no longer voters. That is kind of the situation we're in at this point in time. Can't really change it. We just have to understand what those rules are. The unintended consequence of that is, you know, those individuals are going to get an infusion, yes, but it's going to be a highly taxable infusion of funds. Now, many people will look at it and they'll say, well, the average IRA balance is you know, 100,000, or it's less than 100,000. So for many of those cases, it's not going to be a dramatic change. It's not going to have significant effects on your children or your heirs as far as how that's distributed. But there are people who have accumulated fairly nice and fairly large 401ks, 403bs, IRAs, and that will continue to increase. The IRS knows that that's where the funds are going to be, especially as they make rules for you to start contributing earlier. They know that there will be hopefully another asset base to pull out of there to pay for the government spending that we all live under the rules there. So we have to understand what those rules are. So again, these are some unintended consequences. Peak earning is when you're going to be getting most of these transfers is what they project. And again, these are estimations. Some individuals, it will be after their peak earning years. But for the vast majority of individuals, their 40s and late 50s are going to be when those transfers would generally take place. Also, most people have said, okay, well, I've already made plans with my IRA. It's going to go to my trust. And they've set up a conduit or a pass-through trust. Well, with the way that the rules are now set up, that's going to put a damper on that stretch strategy through that trust. So conduit and pass-through trust as a beneficiary, that's likely going to be eliminated through the stretch IRA for your heirs by using those trusts, because that trust is going to view them as a human. So like we talked about the non-designated beneficiaries, it's humans and sometimes trusts. So they're going to still look at it and likely say, okay, it needs to accelerate and it needs to be paid out over that 10 years. Again, still having the same tax consequences there. It has been a staple of planning for 20 plus years of having a conduit trust being the beneficiary of those accounts. Again, it's going to probably take a few people by surprise. Already, I know I have heard of instances where it has taken many people by surprise since 2020. But if you can, make sure you consult with your professional advisor and make sure that your trust that you have set up, if it was set up before 2019, 2020, when it went into effect, you may want to review how that trust and how, if your IRA assets are going to that trust, how that will be treated. So those are some of the different things as far as the trust trap. And I know I've got to accelerate through a few of these here, Kaylee. So I'm going to go to the charitable stretch IRA of the trust of a charitable remainder trust. So you can stretch it out a little bit. So you can set up a standby charitable remainder trust as the beneficiary of your IRA. And that trust can then name your primary beneficiary as your children, and it can be stretched out over a longer period than those 10 years. You can include children or other beneficiaries within that, that planning strategy. So this one is a kind of a scenario that we could look through. Donor, age 84, has a $2 million estate. $1 million of it is going to be in their IRA and $1 million in house investments. They have 2 children getting into their 60s, so peak earning years. Donor's concerned that maybe one of their children will blow through the inherited cash. I know when I first started, there was a survey of an inherited wealth that was done in the early 2000s. The average inheritance was about $177,000 to an inheritor. And the average time it took them to spend it was about 17 months. So for most individuals, they haven't really stretched IRAs. They didn't set up a plan. They just took those funds and used those funds. But for most parents, they would love to see their inheritance transferred to their children, have a more long-lasting impact there. So what is the advice that I would have as a charitable planner? This is just one possible solution. There are many solutions out there, but if you're looking to support charity and and to support your family, CRT, so a charitable remainder trust, could be a very interesting solution for you. It serves to kind of stretch out, again, the income taxes, similar to what a stretch IRA would do. It does not avoid income taxes, it just stretches it out. CRT is exempt from income taxes as a charitable trust. The IRA by the CRT, it requires the payment of the income tax to your children, but it's going to be in the smaller increments over time. So you can create that charitable remainder trust instrument drafted through your lifetime. The trust benefits your family members. And then after that close of term, then at the passing, those funds come to the charity. Charity pays to your children. After the close of the trust, whatever is left can be funded to support the things you care about within that charity. This is a sample of one that I've done previously. So this one, they had about $400,000 in funds. This was a second marriage. So she had one child, and she wanted to make sure that her spouse was taken care of and that her children were taken care of. So the plan was to, at the passing, take her IRA, which was valued at about $563,000, would fund a unit trust. It would pay to the husband until he passed away, and then to her child, her son, for 20 years a payment there. So as you can see, it would pass through to the child over that 20-year period. It would pay out about $895,000 to the child and to the husband, and then would leave a charitable asset to fund scholarships here at Wesleyan. So really interesting concept, setting that up and putting that through. But this would be kind of the look of it. We would look at, and again, this was done when the charitable exclusion was about 12 million, 11.5 there. It's a little over 12 million now this year, but the income tax limits there, you'd see the tax on the IRA would be lost right away, about $123,000, and it would net the children and the family roughly $439,000. But if we did the trust aspect, it would pay out, like we talked about, close to that $700,000 in income to the family. A present value, and again, discounted present value, would be close to what the original amount of the trust would be, at around $481,000 to the charity. After it was about 27 years of expected payments. And then at the end of it, there would be enough to fund some really nice scholarships there. So that's a unique way to kind of look at the possibility of using your IRA to support your kids, stretch it out over a little over 27 years, but this is scenario, the spouse and then the children. And again, based on some tables, we don't know exactly when people will pass away, but it gives us a little bit of an idea of how these types of concepts would work if that's something you would be interested in. So is it fair? It's questions I get sometimes from individuals. I guess it all depends on who you ask. There are IOUs that are needing to be paid. The government's needed to provide resources in order to pay those things. It is what we're working with, so we all have to kind of find a ways to deal with it and make a plan. That's the biggest thing that we want to promote to individuals through this process, is understand what the rules are and then make a plan to try to figure out what your best solutions may be. And hopefully within that process, you find a ways to be philanthropic. I tell people all the time, we're philanthropic whether we want to be or not with some of these rules. We can do it in the form of taxes, or we can do it in the form of chosen causes that we would love to see go on for generations to come well after we have passed. So that kind of concludes what I wanted to talk about today about the Secure Act in my half hour to 40 minutes. So hopefully that was at least informative for all of you. And if you have questions, I'm certainly willing to answer those.
All righty. Thank you so much, Jordan. As Jordan said, we are open to questions at this moment in time. So Jordan's going to stick around a little bit longer here and answer a few if you have any. You can put those directly in the chat feature, or you can put them in the Q&A, and we will try and get your question answered here within the allotted time. To start with, we will start with one that we kind of discussed a little bit, Jordan. If you are still working right now and maybe in your mid-30s, what is something that you should be doing right now to help minimize the tax burden, to set you up for something like you just discussed? Sure.
So many employers are now offering, instead of the traditional aspect of putting money in pre-tax, they're allowing you to put it in post-tax through what would be considered a Roth account. So you may have a Roth option as far as Roth through your work, through your employer. I would check with your HR office if you're able to, and especially if you're in that age where you're not in a really high tax bracket anyway, pay your taxes today and let the account grow. But once you're at that point where you're wanting to pull out, there's no taxes. I will say the IRA, the Roth IRA or Roth aspect of your 401k or 403b, it will still need to be liquidated in 10 years. But you have already paid the taxes. So there's no tax implication to your children or your heirs if it's transferred through that Roth vehicle. So if you can start early by putting it in Roth, that would be kind of my thought or advice if you're looking at that tax implication long term. But you have to weigh that between that benefit long term to your heirs and what you have to put on your 1040 this year. So if you need to get a little bit of a deduction in your plan, go ahead and do the traditional aspect. There are ways to do Roth conversions of your assets once you get to retirement age. Many advisors will walk you through what's called a Roth conversion ladder, which will help you to pay those taxes while you're living. So that way your heirs and hopefully you live 20, 30, 40 years into your retirement, depending on how early you retire. But if you can do some of those different things by making some changes, either in early funding it Roth or late doing Roth conversions, that would be something you could look to do. Kaylee, it looks like you're muted.
And I haven't done that yet. Had to happen at some point. If you are in a scenario here where you are looking for a financial planner or maybe do not have one yet, what are some things to keep in mind when you're going through that process?
Sure. So going through that process is a little bit interesting. So one thing I would look for is having your financial planner be a fiduciary. That means that they have to act in your best interest. So there's two different standards. There's a suitability standard, and then there's a fiduciary standard. So if you're interviewing financial planners, that's one of the biggest things I'd ask if I were in your seat is, are you going to be a fiduciary? Will you be providing advice to me based on my best interest or based on suitability, based on your client, your company there? Also, you want to make sure that they're understanding your full situation, I think. Many financial advisors will go out and they just want to talk about your investment assets, which is a huge portion. But we've talked about a lot of things within here regarding your estate planning and your tax planning, and maybe even some insurance or risk planning. So a financial planner that has kind of a holistic view versus just individually looking at just your investments is one of the things that I would ask when you're looking at it. So fiduciary first, and then holistic as far as the planning process.
I'm over here taking notes. All right. If you are in a scenario here where you are looking to give yourself they use the term here, a tax-free inheritance to my kids, what assets am I going to be looking in to help with that investment or to make sure that I leave something for them later on?
Sure. So life insurance, so you'll see some people, and another strategy you could look at is with your RMDs is buying paid up premium life insurance, and that life insurance can be transferred to your children with much less tax implications there. As far as inheritances being completely tax-free, that's a very hard thing to do. What we want to do is we want to try to look to limit or reduce those taxes as much as we possibly can. So within that strategy, there's certain assets that are beneficial. So right now, currently, your brokerage account, when you pass away, your children would receive what's called a step-up in basis. So that step-up in basis helps them to be able to defer some of that capital gains tax that you would have had if you were to take it while you were living. So let's say you bought that stock at $10 and it's now trading at, let's call it $100. So if you needed to sell that, you would pay a capital gains tax on that growth there. Well, if you pass away, your child then assumes that cost basis at $100, not that $10 that you had there. So brokerage accounts are nice things to possibly leave to your children, because it does give that step up in basis to them. Now, I will say, as kind of a caveat, everything's changing as far as some of the rules and regulations there, and there have been conversations about eliminating step up in basis on certain types of properties, especially with houses nowadays. I mean, some of these houses our grandparents may have bought at $10,000, $30,000, $40,000, and now they're $500,000. So getting that step up in basis is very, very beneficial to families. But there is talk about maybe adjusting that. I don't know what that will look like. But again, that reminds us that we need to revisit what our planning is quite consistently, because there are rules that change, and we don't necessarily know all the details of those rules. Again, I'm still trying to figure out all the things that are changing within the Secure Act, even with regard to the required minimum distribution rules. I mean, you're talking about just one little section of that change had an issuance of almost 280 pages of theoretical rulings. It's going to take some time to figure out where we're at and how we land there. But if we're looking to try and limit, good things to transfer is to try and do that, and also do it while you're living a little bit. Help them as they're in that developmental stage of getting growth and launching off. I work with a donor couple that what they've decided to do is they've tried to say, okay, with each of our kids, we'll match their their contributions to their Roth IRA. So if they're a couple, that's $12,000. They say, okay, that's $12,000 we can give to our child and their spouse during our lifetime. That helps them be able to get it into their name and their account. You can gift up to $16,000 per individual right now with no tax implications or gift implications there. So that's $16,000 for you and $16,000 potentially for your spouse there. So $32,000 you could give to each child. Do it while they're living. Do it while you can look at them and see if they're enjoying it. Go on some vacations with them. You know, I encourage people to kind of explore that why of why you built wealth. I know sometimes that can be difficult as a natural saver for me, even individually. It can be hard to see those assets go down if you're going to spend them. But you spend them to use them, enjoy it. I would say that would be another thing, is to even do some gifting during your lifetime to your children.
Are there any cons to converting an existing traditional IRA to a Roth?
Yes. Yes.
Focus on some positives here. So give us some cons here.
Yeah.
What's
So again, consult with your own tax advisors and the implications with regard to that. I would say that for all of these responses. But if you're doing a conversion, you're going to have to pay those taxes. So you have to make sure that you are calculating those conversions correctly. You don't want to be penalized for anything. You don't want to do too much because you can get into trouble if you do too much, and there's no takebacks anymore on Roth conversions. So make sure that if you're going to choose to do that, you're calculating everything out correctly so you're not getting any penalties on it. And then even if you're doing it correctly, you have to pay the taxes. So if you're doing that conversion, you're going to put it into an asset that you're not going to really have access to unless you're 59 and a half and older. And even when you do the conversion, there's a 5-year rule that you can't pull out of it. So when you do that conversion, be conscious that what you're putting in, you're going to have to pay taxes on, and there's going to be some limits to accessibility of what you're transferring out of traditional into Roth for that period of time, for that 5-year period. So there are limitations within it. There are tax implications within it. There's accessibility implications within it. But if it works for you and you've gone through the plan and done the process, it is a good strategy to get those taxes paid so you're not having those implications for your children if that's something that you are saying is important to you.
CDs, they have a low rate and they are passed to an heir without taxes. Positives, negatives, practical, not.
So CDs are great for you, I think. This is my personal opinion. But if you're investing for an heir, you want to look at their time horizon. So if your time horizon is for your grandchild who's 20 years old, their time horizon may be looking out 60, 70 years there. By saying, okay, I'm going to limit all of my growth possibilities to avoid any taxes and keep it in an asset where inflation, especially as it's running right now, it's going to be eroded. That's the one thing I would look at, is if you're looking at it for an heir that has a long-term time horizon, it may or may not be appropriate depending on your risk tolerance. So that would be the one thing I would say about that. Yes, tax implications are not that big, but it's really not that big because the growth implications are limited.
All right, we are getting close to our time here. We're going to answer maybe one or two more, if that's okay, Jordan. One here is, any opinion on taking the RMDs and investing them and then transferring those to the heirs? And you talked a little bit on that step in or step up basis as this strategy for this.
Yeah, it would be similar to the answer that I had there. I mean, you take it out, you're paying the taxes there, and then you're able to invest it into that brokerage account. And again, that brokerage account, like we talked about, they have the ability to inherit that with a step-up in basis. Hopefully, those assets that you choose have enough time horizon where they begin to grow there.
All right, last question. I think this is a really good one. What advice would you give to someone who is feeling overwhelmed by this process? A lot of information. Where should they go? What's some first steps?
Sure. You know, our office I'm willing to have conversations with anyone in regards to kind of the overall viewpoint, but really going out and seeking good advice is going to be something that you would want to do. These are all things, especially when you reach a certain net worth. Um, I see a lot of people who kind of do it all themselves. They do it all themselves and they have their spreadsheets and they go through the process and they do it all on their own, which you can do. There are people who are capable of doing it and doing it well. But by missing one thing, you could have huge implications. So bringing a team member on, and I would say make sure that they're a team member. They're not in charge of anything. They're part of your team that is there to help you look at all of the scenarios that are in front of you and help you make the most beneficial choice that you can. There is no perfect choices within financial planning. It is too complex. You know, I can sit down with a couple and the spouses will have completely different viewpoints as far as what is enough for their kids. So you can make a plan and say, okay, this is what I want to do. But if you turn around and your wife says, well, I don't want to do that, it could all derail. So getting someone on your team that's going to walk everyone involved through the process and say, hey, this is what we're doing. This is why we're doing. This is what our policy statement is as far as investment. This is what our plan is as far as our legacy plan is concerned. It can be so helpful for you to put your head at night on a pillow and understand that you're creating a legacy that is going to be a help and not a hindrance to your family.
That's great. Actually, Jordan, I do have one more question that came in here, if you're okay with it.
Sure.
A recent college grad here, and they say, what are the steps to taking the CFP, and do you think it was a wise investment in your career future?
Steps to taking the CFP it's a process. So I did my coursework at Olivet and got into, oh man, this may be a long rambling answer. So that might be a unique conversation for every individual. But for me personally, I got into the financial planning through my work at the university that I worked with. I worked in the admissions office, and then I started working in the financial aid office. And I was sitting down, I was a first gen student. My parents didn't have much. They didn't have a lot to support me. So money was kind of an interesting topic. I didn't have really a great relationship with money growing up and even as I went through school. So when I got through and I was like, oh, I'm working, first gen student, I graduated, I'm making some good money. And then I'm working with families that are making $300,000, $400,000, $500,000. And this was right as we were going into the recession in 08, 09. But they were making almost $500,000 and were on the brink of bankruptcy. And I'd walk them out to a car and they'd be in tears saying, I can't afford to take my kid to school, but they'd have a new Navigator, Lincoln Navigator. So the congruence between what you earn and what you save and what you keep is a unique thing. So that's what drew me to the path of the CFP. So I did my MBA, then went to DePaul, did the CFP and finance coursework, and then took the Dalton review course. They do recommend a nice strong review course even after you do the test or after you do the coursework before you get to the test. And it is a long and arduous test. And I do know that has changed. I was one of the last groups that was doing the paper and pencil one with a calculator, which makes me feel old, I guess, now. But now I think it's all electronic and there's a process there. There's a lot of people that are going to be retiring from financial planning in the years ahead. I will say most of the conferences that I go to, even in my mid to late 30s, I am the youngest person there by a couple decades. So there is going to be, I think, some growth opportunity for individuals that want to get into that field. Being a good advisor is never going to go out of need. So if it's something you're passionate about, if it's something that you can sit there and dive into IRS codes and you can dive into financial planning work and spend countless hours reading and running projections, which is what I like to do, go for it. If that's not what you're into, I don't know that it would be a field for you. So I try to condense that, but that was probably a little long.
No, that's great. And I really appreciate here that, we do have all ages represented on this call, and, it's been interesting to see the questions come in, right? I do want to be conscious of everyone's time though, and I do know, we have hit our moment here. So Jordan, just thank you so much for coming and talking with our Titan community. As a reminder, Jordan is a staff member here within our IWU advancement office, and he is available for maybe additional questions. His contact information will be sent in the follow-up email that's going to go out tomorrow. So you will have access to that as well. And that recording of today's webinar, if you are needing some more additional information or, missed something in your notes, it's going to come out tomorrow morning as well. It will be sent directly to your emails. Again, thank you all so much for attending. Thank you, Jordan, and have a wonderful day.
My pleasure. Thank you so much.